Is America heading towards a recession?
The Dow's down more than 1,000 points as that global sell-off intensifies.
Overnight, Japan's Nikkei plunged 12%. That is its worst day since 1987.
Seems like a recession cannot be ruled out just yet.
If you thought the job market was bad now, just wait until companies respond to this. Before we get into it, I'm Seth. This is Acquired Salary, the best living through career mastery. If you're new here, welcome. If you're returning, welcome back. Stick around to the end because this news is going to have massive impacts on the economy and everyone's job security. So after we get a good understanding of what's going on, I'm going to cover what I'm going to do to make sure that I can weather the coming storm. With that, let's get into it. Some of you may be asking, okay, what's going on here and what's the big deal? Well, the Japanese stock market just had its worst day and it dropped the US stock market. And I'm about to dig into the whole finances of it. However, if you're not interested in the finance side of things, skip ahead and we can get into the explanation on how it's going to impact the job market. When I say the Japanese stock market tanked, it's bad. The overall Japanese stock market had its worst day since 1987's Black Monday crash. Specifically, the equivalent of JP Morgan in Japan is now down 15%. This still raises the question of why does the market crash in Japan impact the US? Well, it's perfectly intertwined through interest rate arbitrage. So as we understand what caused the Japanese stock drop, we can understand how it impacts the US stock market. The Japanese yen is unwinding because of currency carry trading. The TLDR, too long didn't read, is that people have taken over-leveraged positions and are getting margin called, which means the Japanese banks aren't going to make the same amount of money that they were projecting. Therefore, their stock price is going to be overvalued, creating the selling pressure and stock declines. Essentially, the entire world has been in inflation, and in order to fight inflation, they've been raising interest rates except Japan hasn't. Japan has kept their interest rates low because they've been fighting deflation. As a result of low interest rates in Japan, this means the Japanese bond market has a low rate of return, but also yen loans also have a low interest rate. Therefore, the return-minded investor performs some interest rate arbitrage and would take on a loan in yen, convert it to US dollars, then invest it into US bonds. Because the rate of return of the 10-year treasury in the US bond market is over 3 times as high as the Japanese. When this works, it's essentially printing money for the investor, which is compounded by the fact that the yen to US dollar conversion creates a lot of selling pressure on the yen, further keeping yen stable or causing the yen to decrease in market value. Putting some numbers to it, one could theoretically take a loan of $100 of yen, convert it to US dollars, and invest it. And say you earn 5% on your money in the market. Well, as you earn that 5% on your money, the US yen drops in price. So say it drops to $80 equivalent on your loan. So when you go to close your loan, you've essentially made $25 because of the $5 from the US stock market gains, as well as the $20 drop in the conversion. All of this without risking your money. Sounds great, right? Well, it's great until it doesn't work. And Japan, along with the rest of the world, just broke the system. Japan has started raising rates to fight some of the inflation that they're starting to see, and this has changed the compounded upside into a compounded downside because the rest of the world is also dropping interest rates. This makes Japanese bonds more desirable, all the while other countries' bonds are becoming less desirable. So the yen is seeing a lot of buying pressure, raising its market value. Using the same example numbers from earlier, instead of your $100 of yen loan being worth 80 after some time, it's now worth $110. So if you make a 5% return on your money in the stock market investing, you now need to pay $5 to Japan to close out your loan. That means the investor's inherently losing money. So a ton of money has been invested in carry trading, and people are now needing to sell their stocks in the US market to cover their loans from the Japanese market, which drops the US stock market. This is where we can get into understanding how this is going to impact the U.S. jobs market and economy as a whole. We've already started to see some softness in the U.S. economy, specifically the jobs market. As I've covered in many previous videos, we are in a white-collar jobs recession, but at the end of last week, we saw a weaker jobs report, which is a bad omen for the U.S. economy and job market, as we may be on the brink of a full-blown recession. This is because once unemployment raises, we can get into a vicious cycle where companies take risk-mitigating actions to stay in business, such as conducting more layoffs. This starts the tailspin of a collapse in economic prosperity because once people lose their job, they spend less, and the U.S. consumer makes up a large portion of the U.S. economy. So as consumers spend less, companies make less, and if a company makes less, they have to continue taking cost-saving measures such as layoffs or reducing capital expenditure by not hiring. This all makes sense, but the question remains, how does stock price declines feed into this? Well, a company's stock price can have a significant impact on a company's cash flow and margin. A decrease in cash flow means they're going to reduce capital expenditures, which means the recent market drop is going to continue to push companies away from hiring, specifically new roles at best, and at worst, it's going to push them into needing to conduct layoffs. This is where the SAM rule recession indicator comes into play. The SAM recession indicator is a signal for the start of a recession. It's when the 3-month moving average for national unemployment rate raises by 0.5 percentage points or more relative to the minimum of the 3-month averages from the previous 12 months. And the SAM indicator just passed the 0.5% mark, as the recent jobs report brought it up to 0.53%. Another recession indicator is the inversion of the 10-2 Treasury bond yield curve. So historically, once the yield curve inverts, we see a recession strike 2 years within the next 2 years. Well, as of now, the 10-2 yield curve has been inverted since 2022, so recession is seemingly inevitable at this point. Further, as we dig into the jobs report number, it showed the quit rate was the lowest since COVID at 2.1%. This coincides with the lowest hire rate since COVID at 3.4%. Both of these rates being lower than the average in 2019. This leaves us with the question of what now? How can we prepare for a recession and weather the storm? From that standpoint, what am I going to do? I'm making sure to maintain a healthy emergency fund in the case of a job loss. I'm also diversifying my investment portfolio to reduce downside risk. While diversifying, I'm making sure I don't panic sell. Rather, I'm continuing to dollar cost average into investments with the money that I can keep in the market for the long term. Arguably, the most important thing that I'm doing when it comes to my career is I'm continuing to invest in continuing education and valuable skills. I'm not going back to college for a master's degree, but I am working to obtain certifications that are relevant and important to my industry to help ensure I have job security. And finally, I'm not banking on the Federal Reserve to change policy anytime soon because they're likely just going to proceed with their projected rate cuts of slow and steady. But in order to save from a recession, the 25 to 50 basis point cuts just won't cut it. They'd likely need to cut closer to 200 or 400 basis points, and I highly doubt they're going to do this. And if they do it, it's going to be after they get some data that shows, oh, we're in trouble, i.e. 2 to 3 months from now, when companies have cut their capital expenditures by conducting layoffs or not hiring anymore. And at that point, the Fed's going to already be too late, but they're going to panic and cut rates anyway. So it'll help out, but it's not going to prevent the recession in the first place. Overall, I think the economy is in a really tough place right now, and this is all worsened by the fact that there is usually a stock market sell-off with the uncertainty of a presidential election year, so that's also another contributing factor. All in all, what do you think? Please share your thoughts and comments in the comment section below, and if you've made it this far into the video, please like the video and subscribe to the channel so you don't miss out on future videos to help you master your career. If the concepts in this video make sense to you and you want help in upscaling your leadership and strategic thinking skills, I recommend you join the Acquired Salary community using the first link in the description below. There you'll gain access to my Career Mastery course, as well as access to schedule a consultation with me so we can go over how to apply the concepts to your specific situation. Until next time, thank you.